Welcome to this trader's textbook Lunchtime Bite. Today, we are going to look at how we can determine the trend of a market using an indicator. Remember that the trend is the first area of focus in our simple and effective trading setup. To determine the trend, we are going to use an indicator called a moving average. Moving averages are very popular, and most traders use moving averages in one way or another. Trying to determine the trend using a moving average is pretty straightforward. If we take a normal price chart and add a moving average, the moving average indicator is this yellow line that we have here. Now, there are several ways to determine the trend using a moving average, but the simplest and most straightforward is by concluding that if the price is above the moving average, then the trend is considered up. Like we have here and here. Likewise, if the price is below the moving average, then the trend is considered to be down. Like we have here and here. But, what is a moving average exactly? Well, simply put, a moving average is just a visual representation of the average price, based over a certain amount of time. This resulting average is then plotted on a chart. So, it's an average price, based on a certain amount of time periods. And we can make these time periods anything. So, for example, we can look to plot the average price over the last 200 days, or the average price over the past 21 hours, or even the average price over the past 52 weeks. So we can base the average on any combination between the chart time frame and how far back we wish to go. It's important to note that moving averages that are based on smaller time periods tend to be more sensitive to price changes and recent prices. Notice how the average increasingly hugs the price when the number of periods gets smaller and smaller. On the other hand, moving averages based on longer time periods are less sensitive to slight price changes. So let's quickly discuss time frames and how moving averages work across different time frames on your chart. It's super easy. If we have a daily chart and then plot a 200-period moving average, it means that this moving average is based on the past 200 days. So the moving average will show us the trend, or the average price for the past 200 days. And if we are looking at an hourly chart, and then use a 50-period moving average, it would represent the average price over the past 50 hours. Again, the number of periods can be anything, but the time frame of the chart dictates what the number of periods represents. Be it days, weeks, months, hours, or even 1-minute intervals. Now, let's discuss how a moving average is actually calculated. So, we all know what an average is, right? You measure 10 of something, add up those measurements and then divide by 10. And that gives you an average. For example, consider that we have 10 daily candles on a chart. And with these 10 daily candles, assume that we also have their corresponding daily closing prices for each day. Now, to calculate a basic 10-day moving average, we add up these 10 closing prices over the past 10 days. This gives us a total of 133. To then get the average price, we take this total of 133 divided by 10. This gives us 13.3. We can now plot this average price of 13.3 on the current chart. And that represents the average price over the past 10 days. Say for example that it is now the next day, day 11. And the closing price on day 11 is 18. To now get the moving average, moving so to speak, we now calculate the 10-period moving average again. But this time we are starting from day 11 and looking back 10 days from there. So it has shifted. We then do exactly the same thing again. We add up the closing prices over the past 10 days, which this time gives us 136. Again, we divide this number by 10. We now get an average price of 13.6, which we can then also plot on the chart. So we now have 2 points which we can connect together to start creating a line. And so it continues as we move forward in time day after day. The 10-period moving average line then starts to develop and grow and move. It is important to note that when measuring moving averages, most traders will use the closing price from each time period to calculate the average. Traders tend to use the closing price because it's often a nice summary of the period's trading action. The closing price is also often important in terms of communicating sentiment for that particular candle. But theoretically, you can calculate a moving average using the opening price, or the high or even the low as well as the closing price. But 99% of the time, traders will use the closing price to calculate the moving average. Okay, great. Now that we know how a moving average is calculated, how do we actually go about using them? We have already spoken about the moving average crossing above or below the price. And then, depending on its position in relation to the price, we can determine if we are in an uptrend or in a downtrend. So this is the simplest approach to using moving averages to help us determine the trend. As an example, a common number of periods for a moving average when using such an approach is a 100-period moving average, or a 200-period moving average. In this example, we are using a 100-period moving average on a daily chart. When the price is trading above the moving average, it suggests that the relative trend is considered to be up. When it's trading below the moving average, it suggests that the relative trend is considered to be down. It's really that simple. Now, on the other hand, some traders also like to use more than one moving average to help them determine the trend. This approach is referred to as a moving average crossover, and it's an extremely popular way to use moving averages. Here you take at least two moving averages. The first one being a shorter-term moving average, as it's based on a smaller number of periods. And then the second moving average will be based on a longer amount or higher number of periods. For example, here we have a 50-day moving average in purple. This is our short-term moving average. Then we have our longer-term moving average, the yellow one. This is a 200-period moving average. Now when a short-term moving average crosses above the longer-term moving average, it signals a shift. For example, like we have here where the shorter 50-period moving average crosses above the longer 200-period moving average. Something has happened to the trend, and it seems to be continuing to change. A cross-up indicates that the buyers are regaining control and therefore a possible uptrend is emerging. Conversely, a cross-down indicates that the sellers are in ascendance and that possibly a downtrend is forming. These are the two simplest approaches to using moving averages to help you determine the trend of a market. Thank you for joining us today for this Trader's Textbook Lunchtime Bite. In the next Lunchtime lesson, we'll be looking at momentum and focusing on the relative strength indicator and how we can use it. Be sure to reach out to us with any questions you might have. Our contact details are below this video. We hope you have a great day.